During the Fed's most recent meeting, which was held on November 1st, 2023, the Fed decided not to increase their Fed's fund rate, holding it steady at 5.25% to 5.5%. However, Chairman Powell made it very clear that he has no goals on bringing that Fed fund rate down, as they are determined to bring inflation down to their target rate of 2%. A few days after the Fed's meeting, we saw mortgage interest rates drop, which was such refreshing news for everyone in the country, especially home buyers. So in today's video, we will discuss the Federal Reserve thought process on why they didn't raise the interest rates. Then we will dive in and talk about the California housing market and what to expect in 2024. And lastly, for all my home buyers right now, we will run a real lifetime scenario based on the recent rates on what your payment would look like. So stick around till the end for the good stuff. So why did the Fed not raise rates this time around after having raised the rates 11 times since early 2022? Well, number one, they have a lot of pressure from the banking world. Banks are really suffering right now as they're very cash poor because their loan lending volume is a record low. Because the rates are really high, we've seen a lot of buyers on the fences, not buying and holding off, and that's a big reason why a lot of banks are not profitable right now or are struggling to get more cash in the door, because the main factor how banks make money is by lending money. And the other factor that we saw prevalent in this recent little banking crisis that we had, a lot of banks have money tied into the US Treasuries that they had bought when the US Treasury were paying a yield that was a lot lower than what they're paying today. And the price of the Treasuries was a lot higher, and now the price of Treasuries is a lot lower. So their money is tied into assets that are underwater right now. So a lot of pressure from the banking world is one of the main reasons right now that the Fed is holding off from not increasing the Fed's funds rate further. Number two, inflation has been hovering around 3.7% in the last few releases that we've seen, whereas inflation was close to 8% during the same time last year. So this number is indicating to the Fed that consumer spending has slowed down and we have some sort of price stability, which is one part of the dual mandate that the Federal Reserve has. Now, number three, dual mandate part two, which is maximum employment. During this last meeting, Chairman Powell spoke positively about our job market, saying that American economy is strong and our job market is very resilient. Now, I don't want to downplay with all the layoffs that are happening in the tech world, especially here in the Bay Area. The Fed made a comment that the people that are being laid off right now are highly educated people and they are not having too much trouble finding replacement jobs. They also spoke to the blue-collar labor force, which the Federal Reserve believes is holding very strong with a lot of jobs available. Now, the Federal Reserve also doesn't want to have too many jobs out in the open. It's gonna create a lot of employers. They're gonna start to pay higher wages to attract, more employees or employees to come to their company, because now there's just too many vacancies available and employees just have a lot of options. So they also don't want that to happen because that can further cause wage inflation. But the Fed feels confident with the employment figures at this moment. So we got blessed this time with the Fed's fund rate holding steady. Before we move to our next topic, I would like to humbly ask to subscribe to my channel. I notice a lot of you that watch my videos are not subscribed. And if you feel you're getting real value out of this video, please hit that like button, because more people like yourself will be shown this video by YouTube. As I always say in all my videos, I love to hear from you, so don't be shy. Leave me a comment below telling me how you feel about this housing market. Thank you. Moving forward, let's talk about the California housing market. Before we dive into predictions and what's gonna happen towards the end of the year and 2024, let's look at some stats. According to CAR, California Association of Realtors, statewide median home price was $843,340 in September 2023, which is up by 3.2% from September 2022. Next, single family homes sales totaled 240,940. That's the volume, down 21.5% from September 2022. We know why that is. Homeowners are not letting go of their super low rates right now and not selling houses due to such low inventory in the market. That is why we're experiencing unbalance in this market, which we'll get into in a second. but home volume was very low compared to the same time last year. Units sold in September 23, about 5% down from August 2023. Obviously, the rates have an impact, but primarily it's seasonality right now. So in August, we've seen more volume compared to what we saw in September. That's because a lot of folks want to get into houses, especially for their kids before the school year starts. And then when August ends and we start going into the fall months, seasonality kicks in, and that's why we saw a 5% decrease compared to August 2023 in volume. So now let's look at a graph on the board that shows us price appreciation for the different regions in California comparing 2023, so primarily September 2023 to September 2022. So as you can see here, Los Angeles metro area had a 4% increase year over year in home prices. Moving down to the Central Coast, 3.3%, Central Valley, 3.4%, San Francisco Bay Area, 6.6%, Southern California, 4.7%. As you can also see at the end of the graph that year-to-date sales volume is lower in every single region. Los Angeles metro area, 20% lower than compared to last year, homes sold. San Francisco Bay Area, 23.7%. Southern California, 21.7%. Central Valley, 22.5%. A number that is translated pretty much in every region, telling us that inventory has been a huge problem this year with home buyers just not wanting to sell their homes. But price appreciation, a different story. Prices have appreciated almost in every single region in California. Now let's talk about what's going to happen towards the end of the year. We have 2 months left. November is almost, we're halfway there. Expect to see similar results to what you're seeing right now with the rates being where they're at. And it's a big seasonality. It's winter months right now. Seasonality is going to have a big impact. So you're not going to see too many active listings during this time of the year. And this is something that is always there. Seasonality is a big factor. So if you're a buyer looking to buy, you may find some good deals. Obviously, you're gonna see less inventory, less choices in the market, but you're also gonna experience less competition as people are busy in a holiday season. A lot of sellers don't want to sell during this time, so they're gonna hold off and not sell until the early next year or the spring months of next year. But there are still a lot of sellers out there that need to sell right now because everyone has a different situation. So if you're looking for a home, you may find good deals right now in the market. Now moving into 2024, I believe we're gonna still see very, very tight inventory, which is gonna cause the competition to still be there and still be a seller's market because there's not going to be enough homes for buyers out there to buy. Now, National Association of Realtors is predicting that we're going to see at least 20% plus inventory in 24 compared to 2023. We're going to see more houses come on the market, which will give buyers more choices. But due to the low inventory, expect to see year-over-year appreciation. So if you bought a home this year in the San Francisco Bay Area, expect to see 3 to 4% appreciation in value. I don't expect the narrative to change. Housing will still be in fashion because people have seen in recent years, especially the little slump that we had during the pandemic, and then we saw home prices skyrocket. So people really believe in the real estate market. Now it's a different story right now where a lot of people are just outright priced out of the market, but people that can afford housing are buying houses right now. As you clearly saw in the different markets in California, there was year-over-year price appreciation, and the main factor to that was obviously home inventory being shy, but buyers still out there buying. So expect the 2024 market to still be competitive. I don't believe it's gonna shift to a buyer's market yet. We have a huge inventory problem, and we already experienced the rates touching 8%, and we still saw inventory move. Now moving to our last topic of the video, we're gonna look at a real-time rate scenario based on today's rates. Now, you're probably all wondering, well, the Fed's fund rate didn't go anywhere. It stayed the same. Why did the rates drop? The rates primarily dropped because the 10-year Treasury bond yield went down. Now, it can be a positive impact there when the market heard the news that the Fed's not really increasing rates. It could be a positive thing for a lot of people out there, especially banks, that the rates are not gonna go up, we're gonna stay stable. So all this positive news out there caused the 10-year trajectory yield to go down a little bit, causing the rates to go down. So let's go and look at this rate scenario. So if you're getting a conventional mortgage in today's time, we're gonna look at purchase price of $750 Down payment, let's just go with 5%. That's gonna be $37,500. Loan amount, $712,500. Let's just assume your credit score is 720. Based on that, on today's rates, and we're looking at this, today is November 6th when I'm shooting this, and today's rates would be 7.445% at par, meaning like you're not paying points on that rate based on this scenario. Your mortgage insurance would be $213.75, giving you a mortgage payment of $5,168.85. Now, whenever I do these rate scenarios, most of the time I don't put taxes and insurance on there because each state is different and it may not translate to your market or to your local state. So I leave that out. I'm only giving you principal and interest payment and mortgage insurance. Now, moving forward, if you are a first-time buyer and you want to utilize the FHA program, we're going to stick with the same purchase price, $750, down payment $37,500, loan amount is going to be $724,968.75. Loan amount's a little higher than the conventional mortgage because in the FHA, you're financing the $12,468 into the loan, which is a upfront PMI. Now, if you want more information on that, click on the video above. Credit score is 720. Rate's gonna be 6.875%. Mortgage insurance is gonna be $295.49, giving you a mortgage payment of $5,058.02, almost a $200 difference between the FHA and the conventional mortgage if you're comparing apples to apples. So the FHA might be a great option to go with, even though it has that financing charge of $12,468 on this scenario. I've been saying this in most of my recent videos, and it might sound cliche to you, but this is a time to definitely save money, not buy liabilities, and watch the market very closely. Now, my goal here in all of my videos is not to create panic, but to just give you an understanding where the market is at from the lens of my eyes of being a professional in the real estate market. Now, this time may not be the best time for you. If you feel after running the numbers that the mortgage payment is breaking your wallet, by all means do not buy, because at the end of the day, you have to make that mortgage payment. Run your numbers and the numbers make sense for you. It can be a great time to buy because in this market where the competition is a little lower compared to the market when the rates were really low, you can find deals if the numbers work for you. Lastly, the Federal Reserve has one more meeting left before the end of the year, and I believe they're not going to raise rates during that meeting. I firmly believe that they might just sit tight. However, the inflation numbers are coming out also in this month of November, and if they are off the charts, they might think about increasing rates. But if they stay where they're at and they are steady, I don't think the Federal Reserve is going to raise rates in their last meeting. That's all I have for today, guys. I hope you've enjoyed this video. Until next time, this is Karan Singh.